Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, I'm going to share another slide with you. I talked a little bit about the difference between 62 and 70. It's really important when you get into doing your planning of understanding these different ages. So again, at age, here's some that I'll share with you. I think it's age 55. That has to do with, let's say you've left employment, or no, let's say you're still working even. Well, let's say you left employment. So your money's still though in the 401k. You can take money out without penalty. Age 59 and a half is the first point. You got to be older than that to be able to take money out of an IRA without a tax penalty. You still have to pay taxes, but again, to avoid the penalty. Age 62, first time at which you can take Social Security benefits. Age 66 to 67. So let's deal with someone that was born in this example between 1943 and 1954. So at age 66, that's your full retirement age, okay? That's where the gold starts there. So let's say they don't give us a dollar amount here, so let's just pick one out of a hat. We'll say that at age 66, you're going to receive $2,000 in Social Security benefits. All right, well, let's back that up then. That means if you take at age 62, you're only going to get 75% of that, which means your payment would only be $1,500 instead of $2,000. All right? A pretty big difference, $500 a month difference for the rest of your life. Now, one of the things that we do when we do planning, when clients come in, is we show them what the break-even point is. If you take at age 62 or if you take at age 66, somewhere between age 75 and 82 or 3 maybe, depending on the individual, is going to be your break-even. So somewhere we'll say in the 78, we'll tighten that up to the 78 to 80 range. So if you live beyond that, you would have been better to wait because you'll end up with more money in the long run. If you, God forbid, if you've got health issues, or if you're looking at your family situation and saying, I don't see me making age 80, well, maybe it is better for you to take it 62. We weigh all that, and you get to make the choice. We show you the numbers, though, so you see the impact of your decisions on your financial future. Now, this is the other. So I get $1,500 if I take it 62 versus $2,000. Now, what happens if I wait? And this is where you can see for every year that you wait, you get an 8 between your full retirement age and age 70 is an 8% increase per year. Over that period of time, that's a 32% increase. Okay, that means now you would get $2,640 a month if you waited until age 70 versus taking at age 66. That's a pretty significant difference. So if you're one of those that say, wow, mom's 93 and dad lived to be 89 and grandma was 96, or whatever it is for your family history, and you're in good health and your expectation is you're probably going to live to be in your 90s, well, this is where delaying taking Social Security could be a really important thing for you. There are other parts where this comes into play, and this is why it's so important to understand how these things work, how the rules work, and working with someone that understands it as well. Because here's another example. If I have someone, and maybe, sometimes a married couple, there may be an age difference, 5 years, 10-year difference. Well, think about that. If the older spouse is likely to predecease the younger spouse, whichever the biggest benefit, whichever's getting the biggest benefit is what's going to go to the surviving spouse. So if you've got someone that you're married to that's younger than you, one of the things you might think, again, for that benefit of waiting to age 70 possibly, is if you predecease them, guess what? They're going to get that bigger check as well for the rest of their life. So imagine I'm in a situation where I've got a couple, and the man, let's say, is 5 to 8 or 10 years older than his wife. Well, one of the things that he's going to look at, one, men typically don't live, okay, statistically, as long as women. The next is the family pool, the family gene pool. What is in your own health? What's the expectation there? So if you've got a spouse that may live well into their 90s and you may predecease them by 10 or 15 years or more, wouldn't it be a good idea to wait until age 70 so when you're gone, for them, they're going to have that bigger benefit for the rest of their life? That could be the difference, again, of being able to attain and maintain their standard of living, their quality of life throughout their lifetime. These are at least considerations that come into planning for your benefits, okay, when to take benefits. It also has to do with, another thing that's important to understand is taxation of those benefits, and the other is inflation and the effect of inflation. So if we take a look at the next slide, there are cost of living increases that go in with your Social Security benefits, and that's even adjusted before you receive them as well as after you receive them. Now this year there's going to be there's no inflation accordingly, right? So therefore no cost of living increases on Social Security benefits. The reality, of course, we know is that things like health care and food and clothing and the things that we actually spend our money on every day, those are going up, and this is one of the problems when it comes to planning. We have to use an inflation rate of, say, 3% to be safe. And I use this because I base it on the averages over the last 30 to 40 years, not just over the last 8 to 10 years, okay? Because when we look at the long-term picture, I would rather be more conservative here. So a 3% inflation rate, and we figure cost of living based on Social Security statistics being around a 2% average. Yes, this year is 0. Some years are lower, and some years, of course, are higher. We're looking at the averages when we're doing the projections for your future and through your lifetime. All right, so for COLA, or for Social Security, that's how we're going to do that. Now, we'll go ahead and get rid of that slide. Here's something to understand when it comes to your planning, all right? If you're thinking in terms of the cost of living, so if I'm having your expenses grow at 3%, and we separate when we're looking at expenses, if you've got a mortgage, we take the principal and interest part, and we're going to count that differently, because that's going to have a time limit, right? You're going to eventually pay that off, as with any debt you may have. So that's going to be a different calculation, and guess what? On principal and interest, that's fixed, right? Whatever your interest rate is, okay, that's not going to change, assuming you don't have a variable rate, of course. So if you've got a fixed rate, we know that's not going to change, whereas the other expenses, including insurance and taxes, property insurance and property taxes, they in fact are going to go up over your lifetime. So again, we put those in the column of expenses that we apply the inflation rate to. See how this is working? So where your expenses are growing at 3%, our income, now if you've got Social Security, that's growing at 2%. If you've got a pension, if you have a cost of living adjustment that goes with it, a COLA as a part of your pension, some do and some don't. Okay, federal employees for the most part, yes, you're going to have a cost of living. Most state and government employees in general are going to have cost of living. And of course, some private pension holders are also going to have cost of living adjustments. Understanding, by the way, right now, only about 18% of workers today, okay, 1 in 5, if you will, are going to have a pension at all. But those that do, we ask, are you going to have a cost of living adjustment? Is that part of your pension? Some, whatever the pension is, it does not change. Okay, 0 adjustment, which is why sometimes they see it catches up to them faster with inflation to where their income does not keep up with the rapid rate of the increase on their expenses, and they find themselves dipping into their savings, retirement accounts, and that sooner as a result of that. And that's the other part of it. Once we've got your expenses, your income streams, and we've adjusted again for inflation and cost of living increases, and then we look at any debts that need to be paid out, and then we look at additions that you may be making before retirement into savings, or if you even in retirement, if you're making more than you spend, if you're so fortunate to be in that position, then we look at how much is getting added to your capital, your retirement capital. And retirement capital is a combination of all the money you have in the banks, all your savings. It looks at, of course, your retirement accounts, 401ks, 403bs, 457s, thrift savings plans, your TSP, IRAs, Roth 401ks, Roth TSP, all of this, all right, we look at all of that and we say, okay, now how much money are we making on that money? What's the rate of return? What, the way you're currently invested, the way you currently have your money, how much is it making, and what is that going to look like over time? Is that going to shrink, or is it going to grow? All right, and then we look at alternative scenarios for you. That's a part of this comprehensive planning. This is what you get, okay? We're going to show you your financial future. We're going to show you, based on what you're doing today, what that's going to look like year by year by year, so that you see every year whether you're growing or whether you're shrinking, whether you're getting more secure, or whether you're risking running out of money. And then we show you some strategies on ways that you can improve upon that picture to make it look brighter, give you a brighter future, in fact. So again, we're gonna take a break. When we come back, we'll get up on the screen again for the first 10 callers to my office, but first we'll take a break. When we come back, I'll share a couple more strategies and give you an opportunity to take advantage of the free offer this week. Join us here. We'll be right back on the Retirement Report.